Is Home Depot a buy? What a great question. Why don't we ask the Dividend Bloodhound? What's going on, Dividend Chasers? It's the Dividend Bloodhound here with another investing episode. As already mentioned, we're looking at, is Home Depot a buy at the moment? They recently had their earnings call and they did particularly well, beating on revenue and EPS. I bought into this company quite a long time ago, actually, mid-pandemic, when they pretty much just off the bottom. I am now 44% up on this one, 60 or 67 pounds, just on the one share, which is absolutely incredible. I did make a sort of a prediction that people would start working on their homes and working on their gardens if they've got nothing better to do and they're stuck in them due to having to social distance or isolate at home in lockdown. If this video brings you some value, do please hit the like button in the corner there. It helps me and the channel out massively. If you want to see more content like this, then do please consider subscribing to the channel and even ticking that notification bell as well if you're feeling extra kind. Thanks. Home Depot is an American DIY store that deals with all things home improvements, from painting and decorating to your garden, lawn mowing, tools to do so, all of that sort of things, you name it, they will give you the tool, the paint brushes to do it. It is split into two sectors: DIY, as in the customers buy the products, hike it home themselves and do it themselves when they get home, or the professional tradesman sector, where the pros actually take an order, they've got a job to do, they come and get the stores, they probably get a discount for doing so, and then they take it off and they go and build whatever product it is or service that they are going to provide. And Home Depot readily caters to both these people. As I mentioned, they had excellent quarterly results today, or yesterday by the time this video is actually released, and profits were up 25% on the quarter to $4.3 billion, or $4.02 per share, which is absolutely excellent for a company to get during these pandemic times. So the health crisis and the lockdown may have boosted sales, but also, just one caveat there, it also increased Home Depot's cost as well. They actually had to spend over $500 million on prepping the stores to be able to open them to customers and compensate staff that have either been off work ill or unfortunately may have even died from the health crisis, which is obviously very sad. All of this information is from CNBC Business. I will post a link in the description below if you really want to go and check it out. I've also used my own free trade and trading 212 portfolios and dividendmax.com, which I will also link below. Hi again, guys, welcome into the app. So Home Depot, then I'm just going to run you through the fundamentals now. Currently sitting at a price of $285 a share. Dropped a little bit since the market opened today, actually dropped 1%, which is a little bit odd considering they just reported such good quarterly results. But hey, the stock market is really topsy-turvy right now, so who knows. If you had bought this company peak health crisis, you would have picked it up for $152. I think I got in somewhere around here-ish, about the 170 mark, as I picked it up for £150. And now it is worth £220 over in my free trade portfolio. Anyway, let's have a look at the fundamentals. So its ticker is HD. It has a market cap of $301.74 billion, and PE ratio of 27.38, revenue of $110.22 billion, EPS of 10.25, and a dividend yield of 2.14%, which is still pretty good. But obviously, if you bought in at a lower time, you would have obviously been rewarded with a higher yield. They have a net income of 11.24 billion, which therefore means a profit margin of double digits, 10.20%, which is pretty good. This is the area of concern for me right here, the total assets to total liabilities ratio, debt to assets. They actually have 106.08%, which is actually pretty high. You don't want it to be more than what the company actually owns in terms of its assets. So there is a lot of debt to be had there, but it does have a lot of free cash flow, a lot of revenue, and is generating a lot of profit. So it should be able to pay this debt down in the longer term. If we move over to the growth metrics, we can see that its 3-year revenue is 5.79%. Its 5-year revenue growth is 5.23%, which is pretty good. Not quite double digits, but not bad at all. And then we have earnings per share growth over 3 and 5 years respectively of 16.8% and 16.70%. And then we have a compound annual growth rate of 8.28%, which is actually pretty good as well. And then if we have a look down at the bottom here, we have a 3-year dividend growth rate of 25.38%. That is absolutely awesome. This is one of the reasons that keeps me keeping hold of this company over the long term, because if it continues to grow like that at the price that I bought it at, even if I average down with my dividends reinvested and have to pay a slightly higher price, I'm still going to get a pretty good return on my dividends. It's also been paying its and growing its dividends. It's been paying dividends for a very long time, but it's consecutively grown them. It says there for 3 years at 28%, but it's actually been growing them year on year for 9 years in a row now. So it's not quite the same as Lowe's, its competitor, but who's a dividend king, but it is really up there and is really striving towards getting to dividend aristocrat status over the longer term. And it does look like, as long as it keeps that debt under control, it does look like it will achieve that status, which is obviously what us as dividend investors want. That being said, I'm going to park it up here and I'll catch you back outside in the real world. See you there. Hello again guys, welcome back to the real world. Hope you enjoyed the analysis of the fundamentals there that I just conducted. So as you can see, the company is in really good shape at the moment. It is weathering the crisis that we've got going on at the moment quite well. People are going to spend more and more time in their home at the moment. It is a nice, safe place for them to stay, and you can go and grab whatever you need from Home Depot to do that. They're putting into place the things that need to, the social distancing side of things, so you can go and grab your utensils, the tools, whatever it is that you need to go and do it. From an investor's point of view, you can see that they've got really good revenue. That's on the increase year on year. You can see that they've got a really good profit margin, double digits, and that's good going forward. Their free cash flow more than covers their dividend that is at over 2.5. The yield's at 2.14%. If you bought in lower than that, then you've got an even better yield. They've also been growing it for nearly a decade now, so it's not quite the same as they're not quite anywhere near dividend aristocrat status, and I think their competitor Lowe's, the blue logoed one, that does have dividend king status, but its yield is actually lower. But most people will regard dividend king status and the premium that comes with that. They're happy to accept that for a better pedigree of history. But take nothing away from Home Depot here. They've done exceptionally well. In my opinion, they are a little bit expensive at the moment, to be fair. So I won't be buying any more other than reinvesting dividends at the moment until the price comes down a little bit to the 240s, 230s zone, because I just think at the moment investors are desperate to put their money anywhere where they're going to get a little bit of a return on it. That's why we've seen the bubble in the tech prices, and anything that's regarded as a safe-ish investment or lower risk investment, such as tech stocks that are more robust to the pandemic, or UPS even. I actually sold out of my UPS position not so long back because of exactly the same thing. It's been bumped up to record highs. The share price has never been that high, And yes, they've weathered the crisis well, but they've not done so well that it warranted the share price that it's now at. So I actually decided that I was going to sell that one and redeploy the money elsewhere. I don't think I'm going to do that with Home Depot because I actually like where they're going better than I did UPS. However, I have made an exceptional amount of profit in it, bearing in mind I've only bought one share, and getting £70 of a dividends out of Home Depot will take an awful long time to accumulate. So if there's a time where I want to repatriate my money to the UK or take advantage of a heavily discounted UK stock or another US company that I see value in, then I could come with the selling bag basically and sell them off again that way. But I don't really have any plans to do that at the moment, I don't think. And I do value this, I do say that this company for me would be a buy. I'm going to definitely reinvest my dividends, and if I do have some spare cash in that respect, although it's quite highly valued at the moment, I will consider it if I have spare cash and there isn't anywhere that offers better value for money. That's just something for you guys to think of going forward, but do bear in mind that you are paying a little bit of a premium at the moment because it is seen as robust to the pandemic. That being said, I'm going to wrap this video up here. It's been an absolute pleasure to research and bring to you. Do hit the like button if you can. That would be absolutely fantastic and really helps the channel. And subscribe and hit that notification bell as well. That also really helps me out and lets you see even more content just like this one. That being said, I'll see you in another episode. Catch you later. Bye bye.